Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. Inflation is running wild for most countries, from the United States to the UK to France and Germany, etc. In the UK, inflation is already running at over 10%, which is the highest in the last 40 years and is likely to cross over 20% next year. In the Eurozone, inflation has crossed over 9%. In the US, inflation has crossed over 8% and is likely to get worse before it gets better. As inflation increases, our buying power as well as value of cash and saving decreases by the same proportion. In today's video, we will have a look at what should the investors do to protect their investments during such an inflationary period. Let's cover 5 ways to protect your investments during inflation. Before we start, please smash that like button so others can find this video as well, and make sure to subscribe to receive next videos. Let's continue. This is not the first time that inflation is reaching such high levels. We have seen this situation in the past, mainly in the 1970s and 80s, when the inflation touched and stayed above 10%. But the current macro environment with supply chain issues, labor markets, and geopolitical environment, particularly with Russia and China, make it a unique situation. Also, as the Fed and other central banks across the globe raise interest rates, there is a likelihood of unintended consequences that can make the matters worse. For instance, Nobel-winning economist Joseph Stiglitz said that the real worry in my mind is, will they increase interest rates too high, too fast, too far? According to him, this can further increase inflation, mainly because this inflation is largely supply-side constraints-driven and not so much demand-driven. So he asks, will raising interest rates lead to more oil, lower prices of oil, more food, lower prices of food? The answer is clearly not. Given these unique circumstances, there are 5 ways to protect your investments against inflation. First, aim for a well-diversified portfolio. Investors who have a well-diversified portfolio of traditional stocks and bonds may already have some degree of protection, as portfolios such as these have historically tended to grow even in the periods of high inflation. To add additional inflation protection, consider adding stocks related to diversified commodities such as energy, industrial metals, agricultural products, as well as real estate stocks. Second, review your budget. Rising prices from inflation have a greater impact on discretionary spending, as consumers are likely to cut back on non-essential expenses. So, managing our spending and reviewing our budget can be an important lever in reducing the impact of inflation. Consider deferring purchase of consumer goods that have been particularly affected, such as used cars and furniture. Any savings can then be put towards buying inflation protection investments, as shared earlier. Third, review your emergency fund. Given how long the inflation lasts is anyone's guess, we may want to keep more cash on hand in the emergency fund to account for the rising cost of living that comes with inflation. While it may not be wise to leave a lot of investable assets in cash, it's still important to be prepared for any short-term needs. So because prices are rising, we may want to add to our emergency fund to help ensure we are able to cover the costs of an unexpected expense if needed. As a general rule, we should keep aside at least 6 months of expenses. This requires that we understand our daily and monthly expenses properly. Fourth, don't look for comfort in cash. Although we do need to make sure we have enough in emergency funds, we should be careful not to keep too much cash at hand during inflationary periods. In times of volatility and uncertainty, it can be tempting to retreat from the market and reallocate some of our assets into a cash position. But in an inflationary environment, holding cash can be counterproductive. It feels safe because the number in our bank account appears to be stable, but the longer it sits there, the lower our buying power gets. Also, taking money out of the market can have a substantial effect on long-term performance. Missing out on only the market's 10 best days over roughly 40 years has historically reduced wealth by more than 50%. Fifth, optimize your taxes. taxes are one of the main drags on portfolio performance. So the more tax efficient we are, the better off we are going to be. Taking the advantage of market volatility, we should engage in relevant tax loss harvesting and locating tax efficient investments in the appropriate tax deferred or tax exempt accounts. This can allow us to potentially lower our overall tax bill, which can help offset the bite of inflation. For investors, there is no one-size-fits-all response to this inflation. The best course of action depends on your level of wealth and your stage of life. But having a good, robust financial plan can provide some comfort when the markets seem uncertain. For now, that's it from us. Hope you enjoyed and learned from this video. Smash that like button and subscribe to receive the follow-up videos. Thanks for watching.